Hi there everyone, my name is Sakib Ryan, the oil trader here at JNF Capital. This is just a quick update. We haven't had the opportunity to update you on what's been going on in crude oil in the last week or so. So we thought we'd just make a quick video and just give you a quick insight into what's happening in crude oil and how we are basically positioning ourselves here at JNF Capital. Before I move forward with that, I would like to let you know that investing in the financial markets is not for everyone. Trading with CFDs is high risk, and it is possible to lose more than your initial deposit. So, as you're aware, if you've been watching some of my videos, you know what I try to do as a professional trader is to simply identify which entity, whether it be the bulls or the bears, is in control of the market, and then just try and align my clients' funds in the same direction. Okay. Obviously, I try to avoid times when there's not much going on in the market, because there's very little volatility in the market, very little volume as well. Of late, it's been somewhat like that. Now, if we were to have a look and see what the bears are doing at the moment, there is a strong bearish argument out there. We've had massive builds in crude oil inventories down at the delivery point of Cushing, Oklahoma, for the futures contract. I mean, these inventories have been building for the last 15, 16 weeks now, somewhere around there. And last week was a build as well. The week before that was a build. This week was a build as well. So what we're having is excessive crude oil that is basically building up at the delivery point in the storage tankers down in Cushing, Oklahoma. Their maximum capacity is somewhere in the region of about 70 million barrels, and that is about 90% full, just over 90% full now. Of course, there is a great fear that if these tankers were to fill, how would the market react to to that capacity being breached? Now, obviously, that is a bearish influence in terms of an effect it would have on prices. Okay. Now, another thing that we're obviously cautious about is that the last time that the market was trading around these levels was back in 2009. However, at that time, basically the amount of oil being produced was significantly less. Like I've mentioned in my previous videos as well, although the prices were similar, the amount of crude oil was actually less than we're producing right now. Just to give you an example, the US at the time was probably producing somewhere in the region of about 5 million barrels. They're now producing somewhere in the region of 9.3, 9.4 million barrels. So that obviously, if one were to adjust for that kind of production, and by the way, the US is not the only one that's overproducing at the moment, but if one was to adjust for that kind of production, you would see that, of course, fundamentally we should be seeing even lower oil prices. Okay. Another thing, of course, the dollar remains king, as you know. Still, people speculating on when interest rate hikes will take place. And as you know, the dollar is inversely correlated to crude oil and most commodities for that matter. So as long as the dollar stays strong, that's just another factor that will keep oil prices pressured. Okay. Just to add some icing to the cake, Chinese data figures. China is the biggest oil consumer in the world right now, and they were second largest, but now they're largest oil consumer. So naturally, their data figures, the figures that you come out that you can gauge their economic health on, are missing. World Bank, IMF have both revised downwards their estimated growth of China, and the thing that you need to be watching a bit more carefully is the real estate sector in China. Basically it's probably one of the largest consumer of crude oil out there in China. So if those data figures keep missing, that just shows you that there's not enough demand in the market for oil prices to have any form of sustained rally. If anything, it's quite bearish. So that's what the bears are looking at. Now let's see what the bulls are looking at. Okay, so the bulls. What are the bulls looking at? Okay, most of you who follow the price of crude oil would have seen that in the last week or two, we've seen a big rise in crude oil prices. Okay, the market is generally still in a range, but we have seen a decent short-term trend to the upside. Now, one would wonder why are oil prices rising when the fundamental situation about supply and demand that we've just discussed is so bearish. Here are the reasons. It's all geopolitical tension. Okay, as you know, there's a proxy war going on between Saudi Arabia and Iran via Yemen. Okay, I've already told you this before in my previous videos. Basically, the rebels that have ousted the Yemeni president are backed by Iran, at least allegedly backed by Iran. Saudi Arabia does not want obviously such strong influence from Iran right at their southern borders. So what's been going on is that we've been getting reports that Saudi armies, accumulating around the borders, to the north of Yemen, to the south of Saudi Arabia. And of course, those fears of escalation, geopolitical tensions are always going to have a positive effect on oil prices. It will raise the prices of oil. Now, that's basically one of the things. Now, in recent days, we've seen those tensions ease back a little bit, although still there. They've eased back a little bit. Saudi Arabia has, stopped their airstrikes over Yemen. But the fears are still there because we have information that Saudi Arabia feels that there is a credible reason for why the rebels are, still pretty strong despite their 10-country coalition attack on them. Now, the reason being is, of course, like I just said, Iran. So what the US has done is deployed a couple of warships in the region just to try and basically control the situation from escalating any further. But generally, with crude oil prices, anytime you hear anything about war, you hear about any form of geopolitical tension from a major oil producer, you should see a direct impact on oil prices and can make for a really good trading opportunity as well. Another bullish factor that we've seen is Iran. Initially, the second leg that we had down, very brief one, to the bearish side, was primarily due to the talks between the US and Iran out in Lausanne in Switzerland. Now, the rumors were that the Americans had made significant progress with Iran. So the market traders had a fear that all the Iranian supply would then come online and that would further flood the market with crude oil. But in the last few days to week or so, we have understood that Iran wants their sanctions to be lifted immediately. The Americans are not going to do that. The Americans want to see Iran basically implement some of the measures that they've agreed upon when they were in Switzerland together before they lift the sanctions. So that lifts the immediate fear that there'll be a massive flood of crude oil coming from Iran onto the markets anytime soon. Primarily because Iran is not ready for that. They want, like I just said, sanctions lifted immediately. It's not going to happen. Okay. Even if we need to keep things in perspective, even if they did agree and everything was, everything was kosher and they went forward with it, the amount of time it takes to reactivate some of the refineries that have been down due to the sanctions and bring that oil back onto the market is pretty significant. We're looking at anything 12 to 14 months, 16 months from the time that everyone is happy with this, the protocols Iran is putting on their nuclear, projects out there. So basically, from June 30th onwards, the clock would start ticking as to when that oil would come back online. So we're looking at summer next year, really, in realistic terms. It won't be an immediate thing, so we'll deal with that when it comes down when it comes down to it. Now, the last thing we're looking at is rig counts. Rig counts have been dropping very, very sharply. Okay, last week I think we had a drop of about 42 rigs, and then last week we had a drop of about 26 rigs. This basically pretty much more than halves the total number of rigs in operation in the US at the moment. And now the thing is that yes, the rigs are dropping, and yes, there's a lot of really new speculators to the market who are paying a lot of attention to the rig count. You know, it's almost become some sort of fashion, you know, to keep an eye on what the rigs are doing. What they're failing to understand is, yes, they're trading into the upside, rigs have dropped again, this has got to be bullish for oil prices, fine. However, what you have to notice is that the actual production out of the US has not dropped. It's still ticking along, 9.4 million barrels. That is telling you that although the rig count is coming down, it's not an immediate effect on oil prices, okay? We have to see, we have to see that translate into a cut in production. So what that means is that the existing oil wells are still producing at basically at the same rate. However, the exploration of basically the new oil wells has been reduced, okay? So at some point, I guess the next stage is that the existing oil wells will cut production, and you know, possibly that's what everyone's getting excited about when it comes to rig counts. It's not an immediate effect right now. So these are the things that we're looking at: geopolitical tensions, potential cuts in oil production from the US that have raised oil prices. Fundamentally, we're still majorly oversupplied. So, you know, we do see the oil prices coming off, you know, in the future when geopolitical tensions calm down, if there are no meaningful cuts in production from some of the majors. Okay. However, like I said, we keep an eye on what the bulls and the bears are doing, but ultimately we follow what the price is doing. It's all about price, volume, and volatility. So let's see how you know, we've been trading in the last week. So how have I been trading the oil market? Now, those of you who received my oil report, you will have seen clearly that I've clearly indicated that the algorithm at the moment is, the trading strategy is trading around the $51 level, okay, which means that last week any price above $51 was 51.16, I believe it was, is a buy, okay. My entry prices, second round of entry prices was 53.59 with a target of, I believe, 54.62 and 55.97, something in that region. Now, both those targets, as you know, if you've been following the price of crude oil, both of those targets were met. So what I'm trying to say is, had you been receiving my oil report, you would clearly see where you know, where we're looking to potentially go long, where we're looking to go short as well, and what our profit, you know, take profit targets are as well. In order to gain access to that oil report, please get in touch with myself or my trading team. My contact details will be shown on the following screen. Alternatively, you can follow me on Twitter as well. I occasionally tweet out relevant, important information regarding the crude oil market. I also sometimes share my trading levels as well. We send that report out for free initially. It's for a trial period, so that you get a feel of what our analysis is like here at JNF Capital, and then we can talk about, you know, doing some business together. That's all for me this week. I'll probably be touching base with you early next week, give you an insight on what's happening in crude oil. I wish you a profitable trading remainder of the trading week and a good weekend.